Today, I want to tell you a quiet secret Charlie Munger learned over a lifetime. Every major market crash, every violent downturn, every moment when people lost everything, they all began the same way. Not with panic, not with fear, but with calm. A strange calm that appears about 6 months before the collapse. Munger said the market always whispers before it screams. And if you can hear those whispers, you will never be the one standing in the storm without shelter. People love to believe in miracles, especially in a stock market. And every time history builds a bubble, the same 4 words rise like smoke across the world. This time is different. You saw it in 1929. America was dancing in the jazz age. Stocks doubled and tripled. Newspapers told people they were entering a new era. No risk, no gravity, no limits. 6 months later, the market collapsed so violently that an entire generation refused to touch stocks again. You saw it again in the year 2000, the dot-com boom. Companies with no revenue, no profits, no products. Yet everyone said the internet had changed the rules. Valuation didn't matter anymore. Click counts and dreams were the new currency. Then the bubble burst. Trillions vanished. The rules hadn't changed. People had simply stopped looking at them. And then came 2008. Real estate was the new religion. Banks promised that housing prices could never fall. Families bought 3 homes with borrowed money. Credit was cheap. Optimism was free. The warning signs were everywhere. But the world said the same thing again. This time is different. Then everything collapsed in a single brutal chain reaction. Even in 2021, we saw a softer version of the same illusion. Meme stocks, cryptomanias, spacies with no business model. People genuinely believe the old rules no longer applied. But every time a crowd begins to feel invincible, history begins to tighten its grip. Charlie Munger spent 99 years watching this cycle repeat. He said the 4 most dangerous words in investing are not spoken by experts. They are whispered by crowds, and they always appear about 6 months before the crash. This time is different is not a prediction. It is a warning, a sign that people are drifting into fantasy, a sign that reality is preparing its return, a sign that the storm clouds are already forming beyond the horizon. When you hear those words, not from one person, but from everyone, from media, from friends, from strangers online, you are no longer in the safe part of the market. You are in the final chapter of the story, the chapter where human nature forgets what pain feels like, right before the market reminds them. Munger said, you don't need to be brilliant to survive these periods. You simply need to stay awake while others are dreaming. Because whenever the world insists that the old rules no longer matter, that is precisely when the rules are about to return with force. If the first warning sign is fantasy, the second is fuel. And that fuel is leverage. Every great crash in history begins the same way. People stop asking whether they should borrow and start asking how much they can borrow. Credit becomes a lifestyle. Debt becomes an accessory. Risk becomes invisible. Look back at 2008. It did not start with panic. It started with confidence. Banks handed out loans like candy. Families bought homes they could never afford. Investors packaged those debts into beautiful boxes, rated them as safe, sold them as masterpieces. Leverage sat quietly underneath everything, growing, multiplying, preparing its revenge. Or think about 1998. long-term capital management, the smartest men in the room, Nobel laureates, mathematical geniuses, they believed their models could control risk, so they borrowed $30 for every $1 they had. When markets moved a little, their leverage moved a lot, and the entire global financial system shook. Even Japan in the late 1980s, a nation convinced that land prices would rise forever, banks lent aggressively, corporations borrowed heavily, and leverage inflated the largest real estate bubble the world had ever seen. When it burst, Japan lost 3 decades of growth, and in 2021, we saw the pattern again. Zero interest loans, margin accounts exploding, crypto traders borrowing from crypto exchanges, people turning every dollar into 5, every 5 into 10, every 10 into a fantasy of endless gains. Leverage felt like a shortcut to wealth, but shortcuts often lead to cliffs. Charlie Munger warned about this again and again. He said, leverage is like climbing a mountain with a rocket strapped to your back. If everything goes perfectly, you fly. If one thing goes wrong, you don't fall gently, you explode. The danger is not leverage itself. The danger is how normal it becomes. Borrow and feel smart. Everyone is doing it. Friends brag about returns pumped up by debt. Banks encourage it. Apps make it easy. Suddenly, leverage is no longer a tool, it is a habit, a reflex, a culture. And that is when crashes are born, not in the chaos of panic, but in the silence of confidence, when borrowing feels safe, when rules feel suspended, when people forget that debt is a promise the future must keep, and the future does not always cooperate. Munger said, survival is the first rule of compounding, and nothing kills compounding faster than leverage used blindly. When you see borrowing becoming casual, effortless, celebrated, that is the moment you should step back, because the wave is rising, and waves do not rise forever. Every bubble has a moment when prices stop behaving like prices. They stop reflecting value. They stop following logic. They begin to float, as if gravity no longer applies. Charlie Munger said that when markets forget gravity, they soon remember pain. Look back 300 years. The South Sea Bubble of 1720. A company with no real profits, no real operations, yet its stock soared more than 1,000%. People believed government ties would make them rich. Even Isaac Newton invested, then panic hit. Prices fell so fast that Newton reportedly said, "I can calculate the motion of the planets, but not the madness of men." Fast forward to the year 2000, the dot-com boom. Companies with no revenue were valued higher than century-old businesses. Founders promised eyeballs instead of earnings. Analysts said profits didn't matter. It was a new economy. But markets are not new. They are ancient. And when gravity returned, the NASDAQ lost nearly 80% of its value. The dream dissolved as quickly as it inflated. Then came 2021, a softer bubble, but the same pattern. Crypto coins created as jokes reached billions in value. Companies going public through SPACs had no profits, no products, sometimes not even a plan. Meme stocks soared because strangers on the internet believed they could rewrite financial physics. For a moment, it felt like laws no longer applied, like value was optional, like prices could float forever. But gravity never disappears. It only waits. Munger often reminded us, eventually, valuation matters. It always matters. It cannot not matter. When prices rise faster than cash flows, faster than earnings, faster than reality itself, you are no longer investing. You are drifting into the sky on a balloon filled with hope. And balloons rise beautifully until they don't. The real danger is not the rising price. It is the story behind it. People begin to say, this company is different. This time, the rules have changed. We don't need profits yet. Narratives replace numbers. Dreams replace discipline. And that is the moment Munger paid attention to. Not the euphoria, not the rising charts, but the detachment, the disconnect between price and value, the feeling that the market is building castles in the air. When valuations lose gravity, crashes don't just happen, they become inevitable. Munger said the cure is simple: return to reality, return to cash flow, return to companies that make sense even when the dream fades. Because gravity always returns, and when it does, you want your portfolio standing firmly on the ground, not floating in the clouds. Every major bubble has a final chapter, a moment when the market stops being a place for investors and becomes a playground for the crowd. Charlie Munger said the end always looks the same. It begins quietly. Then suddenly, everyone you know is investing. Look back at 1929. Taxi drivers, factory workers, even high school students borrowed money to buy stocks. People believed the market could only rise. Newspapers printed daily stories of easy riches. The country forgot risk, forgot fear, forgot history. It was the final rush before the fall. Then remember 2000. During the dot-com mania, college kids day traded between classes. People quit stable jobs to trade tech stocks from their living rooms. Strangers became overnight millionaires, not because of skill, but because of luck wrapped in hype. The crowd surged into the market like a tidal wave, and when the wave crashed, only silence remained. Or consider 2021, a softer bubble, but the pattern was identical. Millions of new traders opened brokerage accounts for the first time. Gamified apps made investing feel like a video game. Meme stock rallies turned social media into a battleground of emotions. People who had never studied a balance sheet were betting their savings on charts, trends, and rumors. New voices filled the market, loud, confident, fearless. This is the hallmark of the final stage, when people with no experience feel invincible, when beginners believe they have discovered shortcuts that masters never found, when speculation becomes social entertainment instead of financial responsibility. Munger said, when the crowd arrives, discipline leaves. The danger is not that new investors enter the market. It is that they enter for the wrong reasons. They are chasing excitement, approval, identity, not value, not quality, not long-term wealth, and crowds behave differently. They move fast, they move emotionally, they move as one. When they rush in, prices surge. When they rush out, prices collapse. There is no thinking, no patience, only momentum. Every bubble in history ends with this stampede. The room becomes crowded. The noise grows. The air feels electric. People celebrate gains they didn't understand and ignore risks they can't see. Munger watched this happen for nearly a century. And he said the moment you hear everyone around you talking about the market, the barbers, the students, the influencers, the friends who never cared before, you are not early. You are late. Very late. Because the crowd rush is not the beginning of opportunity, it is the end of it. And when the crowd finally realizes that the market is not a casino, but a mirror of reality, it is usually too late. The exit doors are small, and the crowd is large. Every market cycle has a moment when people stop asking the most basic question in investing. Does this business actually make money? Charlie Munger paid attention to that moment because it always signals that the market has crossed a dangerous line. The line where hype becomes more valuable than truth. Look back at the dot-com boom in 2000. Companies with no revenue were valued higher than companies with generations of profit. Founders promised the future, analysts talked in beautiful metaphors, and investors stopped reading financial statements altogether. People bought dreams, not businesses, narratives, not numbers. Munger said, "When people prefer stories to facts, the ending is already written." You saw it again in 2008. Banks created products so complex that even insiders barely understood them. Ratings agencies stamped them as safe. Investors trusted the labels instead of the math. The world believed that housing prices would rise forever. No analysis, no skepticism, only confidence built on sand. And then came 2021, the most modern example, but the same old pattern. Meme stocks soared because the internet said they would. Crypto projects with no utility reached billions in value. Influencers became investment advisors. People believed more in momentum than in management, more in hype than in cash flow. When fundamentals fade, noise gets loud, very loud. You hear phrases like, "This company is rewriting the rules." Profits don't matter yet. Growth is everything. It's a new paradigm. These words appear in every bubble. They are not explanations. They are excuses. Excuses we tell ourselves so we don't have to face reality. Munger warned that the most dangerous time in a market is not when companies perform poorly. It is when investors stop caring whether they perform at all. At that moment, the market becomes a popularity contest. And popularity has never built sustainable wealth, not once in history. Fundamentals are boring, cash flow is boring, long-term earnings power is boring. But boring is what survives, boring is what compounds. Boring is what keeps your portfolio safe when the music stops. Because hype is addictive. It feels good, it feels fast, it feels easy. But it collapses the moment people stop believing. Reality doesn't need belief, it stands on its own. Munger said the cure is simple. Buy businesses that would make sense even if the market closed for 10 years. When hype becomes the driver of price, when fundamentals get pushed into the back seat, when people no longer ask about earnings, management, moats, or culture, that is the moment you should step back, because the market is no longer anchored, it is drifting, and drift always ends the same way, with a hard return to the truth. Every crash has a strange and quiet moment before it begins. A moment most people never notice. A moment Charlie Munger considered one of the most reliable warnings in all of investing. It is the disappearance of fear, not panic, not volatility, not chaos, but the opposite, a calm so unnatural that it becomes dangerous. Look back at 1929. In the months before the crash, the market barely moved. Newspapers said America had entered a permanent era of prosperity. People believed the economy had mastered itself. Fear felt old-fashioned, unnecessary, obsolete. Then, almost overnight, the calm cracked open and the markets fell like a building with its foundation ripped out. The same silence appeared in 2007 and early 2008. The VYX, the fear index, dropped to historic lows. Economists predicted a soft landing. Banks claimed their models eliminated risk. Investors slept peacefully, unaware that the storm had already begun forming beneath their feet. When the cracks finally appeared, they spread faster than anyone could react. Even in 2021, before the tech correction, the same eerie calm returned. Every dip was bought instantly, every correction was reversed within days. People truly believed markets only moved upward. Fear was gone, completely gone. But markets without fear are like forests without wind. They accumulate hidden pressure until one spark destroys everything. Munger said, "When people stop being afraid of losing money, that is when they are closest to losing a lot." Fear is not an enemy in investing. It is a compass, a guardrail, a reminder that risk still exists. Without fear, investors take bigger risks, borrow more, chase more, ignore more. Greed spreads quietly like fog at dawn, soft, invisible, until it blinds everyone at once. The calm before a crash often looks like stability, slow daily gains, low volatility. Everyone relaxed, everyone confident, everyone convinced they have solved the market. But calm is not safety. Sometimes calm is the final inhale before the plunge. Munger believed that real investors do not fear volatility. They fear complacency. When markets feel too smooth, too easy, too predictable, that is when he would become careful. Not because he expected disaster tomorrow, but because he knew human nature, knew cycles, knew that silence often comes right before history raises its voice. If you ever find yourself in a market where nobody is afraid, where risk feels irrelevant, where dips feel impossible, where everyone is relaxed, remember this truth. The absence of fear does not mean the absence of danger. It means danger has stopped knocking and has started walking in. When you see these 6 signals appear together, not one, not two, but all of them, fantasy, leverage, weightless prices, crowds rushing in, hype replacing truth, and fear disappearing, that is the moment to slow down, not to panic, not to predict the exact day of the crash, but to prepare. Charlie Munger always kept cash. Not because he loved cash, but because he loved opportunity. He said the worst feeling in investing is watching the world crumble and realizing you have nothing to buy with. Cash is not an idle asset. Cash is patience. Cash is discipline. Cash is a seat on the lifeboat when the ship begins to tilt. Remember the painful lessons of history. 1929, 2000, 2008, even 2021. Every cycle punished those who forgot and rewarded those who waited. So when these signals whisper to you, keep a portion of your portfolio in cash. Protect yourself, stay calm, and be ready. Because crashes are not only moments of danger, they are moments of rebirth, moments when great companies return to reasonable prices, moments when discipline becomes a superpower. Munger said you cannot control a storm, but you can control your shelter, and you can control your readiness. Stay patient, stay rational, stay liquid. The next opportunity always comes to those who wait with clarity and act with courage when others cannot.